On a freezing stormy night in November of 1910, 6 men secretly boarded a train at a New Jersey train station. Their identities were concealed, their mission a mystery, and one after another these men boarded the train using only their first names to hide their true identities. Their destination was faraway Jekyll Island, a very exclusive and remote retreat off the coast of Georgia. Officially, they were meeting for a duck hunt, but that was just a ruse. Over the next 9 days, these men locked themselves away and worked very hard on a plan that would forever change the world. From this meeting emerged one of the most consequential plans in American history, a proposal to create a new central bank. Only a few years later, with some minor changes, Congress passed the Federal Reserve Act, making this proposal a reality. This ominous, hard to believe but true story brings us to today's video. Because the Fed is number one of the most powerful financial entities in the entire world that can, number 2, make or break the economy at any given point, and number 3, because its creation story is so darn mysterious. Let us learn more about the history of the Federal Reserve, who controls it, and what insane powers it has. But before we get to all this, let me ask you a question. Do you know when the dollar emerged? Serious question. When was the US dollar created? After the Declaration of Independence? Maybe when the Constitution was written, or even after the Civil War? If you don't know the answer to this question, don't feel bad. I didn't know either a year ago. Actually, the question is not that easy to answer. Although we take the Federal Reserve and the modern-day dollar for granted, they've only existed for a bit over 110 years. Hard to believe nowadays, but in the early days of America, having something like a central bank used to be super controversial. That is because central banking in many ways is opposed to the founding vision of America. That of limited government of, by, and for the people to guarantee life, liberty, and the pursuit of happiness. Americans were historically very much against centralization of power or a strong federal bureaucracy. And in this spirit, it's quite obvious that an agency like the Federal Reserve that controls the economy and currency wasn't very popular. There were a few attempts to create a central bank in the early days of American history, but always with vehement opposition, and eventually their charters expired. Read this text while you're curious. It's a pretty badass quote by President Andrew Jackson. Andrew Jackson aside, but we still actually don't have an answer as to when the dollar emerged. Prior to the Fed, the US had a super complicated monetary system with multiple competing currencies at the same time. Essentially, there were different kinds of dollars over American history. That to me was very surprising, but people essentially used different types of dollars issued by different institutions from different parts of the country and even from different periods at the same time. So again, the entire American financial system was a colossal mess in the 19th century. Because of this, it was also very common for regional banks to lend too much money to overextend and then default on their debts. Banking panics were quite frequent, which is something we tend to forget nowadays. It's very popular on the internet to criticize the Federal Reserve, but we should remember when and how it emerged. In many ways, the Fed was created to rid America of these constant banking panics. Now, whether the Fed successfully stabilized the American banking system and economy is another question, but we should never forget that this was a core justification for the Fed's creation. Which brings us back to Jekyll Island. In November of 1910, a few ultra-powerful men met on beautiful Jekyll Island. Among them were bankers, financiers, and politicians. And over several intense days, they crafted a detailed plan to establish a new central bank in America. One participant was keen making this plan a reality, Senator Nelson Aldrich. After the Jekyll Island meeting, he carried this plan back to Washington, D.C. After some adjustments and debate, Aldrich's proposal was ultimately passed by Congress and signed into law by President Woodrow Wilson in 1913. Without doubt, the Federal Reserve Act is among the most monumental events in American history and also in the history of the 20th century.
There is no authority in the Constitution authorizing a central bank, which means there should be no Federal Reserve System. No!
Now let us talk about who controls the Fed. Because the Fed was brought to life by the Federal Reserve Act, Congress theoretically has supreme power over it. This means at any point, Congress has the right to repeal the Federal Reserve Act and abolish the Fed. Even theoretically right now. Now, whether that's practical is another question, because to be honest, the entire economy is nowadays super reliant on the Fed, and repealing it would create absolute economic chaos, at least in the short term. But while its existence is controlled by Congress, the Fed acts independently. Neither Congress nor the President can dictate what the Fed does, and this was done intentionally. We can see this right now from the spats between Trump and Powell, where Trump urges the Fed to reduce interest rates. So it actually has an astonishing degree of independence, considering that no one on the Fed is ever elected by the population. The function of the Fed and its structure. The Fed's most important responsibility is to conduct monetary policy, and this responsibility is fulfilled without asking Congress or the President. Monetary policy is mainly guided through two different approaches: open market operations and interest rates. Open market operations is when the Fed buys or sells government debt, and more recently after the 2008 crisis, when they bought and sold mortgage-backed securities. When the Fed does trade such assets, it does so either to flood the market with money and stimulate the economy, or to suck money out of the economy and to cool down an overheated economy. Additionally, the Fed can also set interest rates to manage inflation and stabilize the economy. So how does the Fed make decisions on monetary policy? We all kind of know from watching the news that the Fed governs monetary policy, and especially in times of crisis, most of us have probably anxiously awaited what Jerome Powell would say in a press conference. But how does the Fed actually make decisions on this? How do these decisions work? The structure of the Fed is made up of three interconnected but different entities. First and famous comes the Board of Governors. The Board of Governors, as the name suggests, is made up of 7 different governors. These guys are probably the most powerful people in the Fed, and you know historical examples. Right now, Jerome Powell, but also in the past, Ben Bernanke, or even way back, Paul Volcker. Every 2 years, a new governor is appointed by the president and then confirmed by the Senate to then serve 14 years. Thus, the public does have a bit of a say over the Board of Governors, because every single governor is appointed a bit like a Supreme Court justice, only that they don't get to serve for their entire lives. And after they're picked, they also act independently, again similar to Supreme Court justices. Powell, for example, was appointed by Barack Obama back in 2012 and then nominated as chair of the board in 2017 by Donald Trump. These governors make rules for banks to keep them safe and fair. They watch over the whole banking system and cooperate with other central banks around the world. Their most important task is to govern monetary policy. The regional reserve banks. In addition to the Board of Governors, we also have regional reserve banks. How they're managed and controlled is a bit less obvious and slightly more complicated. The reserve banks are a network of decentralized regional banks. There are 12 in total for the different districts throughout the country: Boston, New York, Philadelphia, Cleveland, Richmond, Atlanta, Chicago, St. Louis, Minneapolis, Kansas City, Dallas, and San Francisco. And although they're regional, these banks are also called Federal Reserve Banks. So for example, Federal Reserve Bank of New York or Federal Reserve Bank of St. Louis. To make things even more confusing, these regional reserve banks aren't proper government agencies. They're more like a hybrid between company and government. Every single reserve bank has stocks, just like a company does. However, these shares cannot be owned by people like you or me. They're owned by commercial banks. Think of JP Morgan Chase or Citibank. One of the main benefits of having shares in a reserve bank is that you get to vote on its leadership. Because all of this is quite complicated and there are a lot of details that we won't get into, I will concisely summarize one more time what reserve banks are. There are 12 regional banks that are part of the Federal Reserve System. The shares are owned by commercial banks like Bank of America or Citibank. Owning shares confers voting rights. So if you own shares in a regional bank, you get to vote on the leadership. One of the responsibilities is to provide commercial banks with liquidity and distribute paper money, so think of cash and coins. They also do a bunch of supervisory and regulatory work within their district. More famously, if you've ever seen charts from the Federal Reserve, think of interest rates or the balance sheet, a lot of these charts are made by the Federal Reserve Bank of St. Louis. However, the most consequential task of these regional banks is done in conjunction with the Board of Governors. That is, yet again, to conduct monetary policy. The Federal Open Market Committee. The Federal Open Market Committee, in short, FOMC, is the third entity of the Fed and probably the most important. It is probably also one of the most powerful committees in the entire world. During times of great crisis, like during the pandemic or the mortgage crisis in 2008, the decisions of the FOMC in many ways are more important than those of presidents or prime ministers. Its job is to conduct monetary policy and to fulfill its dual mandate, that is, price stability and full employment. The FOMC, interestingly, is not really its own entity, rather it's a combination of the Board of Governors and the 12 regional reserve banks. The Federal Open Market Committee has 12 members in total. The first 7 of these members are from the Board of Governors. The 8th member would be the president of the Federal Reserve Bank of New York. This guy has a permanent seat on the Fed. And the other 4 members are from the remaining regional reserve banks, serving on a rotating basis. The top G of these 12 committee members will be Jerome Powell, probably the most famous and the most influential. He's the chair of the FOMC. Most of the time their meetings are quite boring. They're only really watched by journalists, maybe Wall Street bankers and crypto traders. But in times of crisis, the FOMC makes insanely consequential decisions that affect all of us. For example, March of 2020, during the COVID pandemic, the FOMC decided to cut interest rates rates to almost zero. It also began buying tons of US government bonds to support markets and set up emergency loans so banks and even businesses could keep borrowing money. This is where most of the controversy around the Fed lies. Many people are skeptical to hand over so much power to a few unelected bureaucrats, and probably also the long-term consequences of their decisions are way underestimated. Do we really want to have a few ultra-powerful people that can make or break the economy, and they make their decisions kind of hidden away from public eye? I don't know about that. Maybe we should remember the Jeffersons and Jacksons that so bravely fought central banking approximately 200 years ago. However, if you do believe in central banking, the structure makes quite a lot of sense. You simply don't want monetary policy to be voted on by the public, to have the public vote on half a percentage point increase or decrease in the interest rates. So as long as we do have a central bank, I guess the structure makes sense by and large. Now I'd love to hear your opinions in the comments down below. If you enjoyed, please like and subscribe, and I will see you guys next time. Bye bye.